All right, hello again, everybody. This is Mike Rixey. I am the lead options instructor for NetPicks, and this is our weekly options recap. What I want to do with today's session, walk you through some of our trades that we've taken here this week, both on the closing side and also a trade that we opened up yesterday afternoon. We'll also walk you through a couple things that are catching our eye for next week, potential trades that are there on our radar for next week. As always, if you have any questions along the way here today, feel free to type those in if you're joining us live. If you are watching the recording, feel free to post a comment there in Facebook or YouTube, or you can email me directly, mike@netpicks.com. All right, so let's talk about a market that just continues to be absolutely relentless on the upside. I mean, it's amazing. I'm at a loss for words on some of these moves that we're seeing. What you're seeing on the screen here is a daily chart of SPY, right? And I posed the question in the title of the webinar: Is the SPY, is it ready for a pullback? If we take a look at this daily chart, I mean, a lot of green here on the right-hand side of the screen. It's basically been 2 weeks in a row of solid gains to the upside. We did make a new all-time high here today. In fact, at the time of this video, we are pinned at the highs, right around 409.55. So now our question becomes, where do we potentially see resistance on the upside? I talked about it earlier in the week. We now shift our focus because we have had no previous moves up this high. We're at an all-time high. Our focus shifts to the big 0.50 and the 0.00 levels. So right here, 409.50, 410, 410.50. Those are going to be the next areas that we'll want to watch for potential areas of resistance. If we do start to see some selling, and I'll start to tell you why I'm expecting that here over the next few moments. But if we do start to see some selling, where would I potentially look for as support? The AEMA, which is at 404.27. That is that solid pink line there on my chart. If I zoom in, you can see it in more detail. That would be the first area that I'd want to look at for potential support. Not expecting a huge move lower, not expecting the market to crash by any means. But at this point, we're at all-time highs, 2 weeks in a row of solid gains. Want to see a reset. I want to see a pullback. I think we're going to get a more sustainable move to the upside if we get a pullback first. Now, notice what's happened on this latest move to the upside. Look at the volume picture down at the bottom. This is the first reason why I'm expecting a pullback in the near term. On this latest move to the upside, notice how the volume has absolutely contracted. If we go back into March, where we had some decent two-way action, we had some moves in both directions to work with, the volume was on a regular basis over 100 million shares. Now that we're starting to see this market, get back into that one-way move to the upside, it's been a struggle here this week to hit 50 million shares. Right? We're seeing half the volume on these latest moves to the upside. It's very typical of a late stage move. Doesn't mean the market has to turn immediately. Doesn't mean we're going to see a huge move to the downside, but it is something to keep an eye on. If we continue to see the volume contract, it's going to be more difficult for this market to sustain the pace on the upside. Notice what's happening to the ATR as well. We've talked about this in recent sessions. The average true range. Look at how this has completely just fallen off a cliff here, especially the last couple of days. If we go back into March, we had an ATR up above 6. We had great moves back and forth intraday. Now we're struggling to hang on to the 4 handle. The ATR is sitting at 4.3. When you start to see range this tight, we've seen it this week. We've had very little movement intraday. It's been like watching paint dry all week. As active traders, we want the good movement back and forth. We don't want the one-way move to the upside, just like we don't want the one-way move to the downside. I want to see back and forth movement. That gives us way more opportunity. That's why we saw such great returns in the first quarter, because we had good movement back and forth. Ultimately, the market continued to move higher, big picture, but during that stretch, we had more movement back and forth. And it gave us a much better environment to work with. The last 2 weeks, it's definitely more of a challenge because it's chasing new all-time highs every single day. Very difficult to do that and to get the numbers in your favor long-term. Let me show you what I'm talking about. If I go over to switch this chart up here from NFLX to SPY, I want to take a look here at the 195-minute chart on SPY. The daily chart that we were just taking a look at, I like to use that to gauge overall market sentiment. Where are we heading big picture? Because that can help shape how aggressive or conservative I am with the trades that I'm taking. Am I taking more long calls, long puts? Am I using more vertical spreads? Am I using more weekly options or more monthly options? That daily chart really gives me a good glimpse into overall market environment. This 195-minute chart, I'm going to pull up the 130-minute chart here in just a second as well. I love the 195 and the 130 because they speed things up a bit. If we just take a look at that daily chart, long term, it's more difficult to get that chart to work because it's slower to react. Okay, you need more of a big directional move with follow through to get the daily chart to work. It can work in some cases, but I find the 195-minute to be a better time frame for us. Now, notice what's happening on our pulse indicator down at the bottom. It's this red and yellow histogram, and it's been yellow all of this week. That indicates that price is between a 1 and a 2 standard deviation move on the upside. It doesn't mean that this move has to reverse. I continue to pound that point home here because I continue to get emails from people saying, Mike, I thought you said we're overbought. I thought you said we're going to reverse. When we start to see yellow bars in the pulse, it doesn't mean price has to reverse immediately. It just means the odds don't favor a continuation to the upside here. It's just not statistically probable. If I go back and take a look at the previous cases, when we had yellow bars on the pulse, in both of those cases, it was on the downside. And did price action reverse immediately? It happened relatively quickly, but it wasn't just in the snap of a finger. In some cases, it might take a couple of days, even a couple of weeks before price action reverses. But what typically happens when you start to see these yellow bars, you're going to start to see slower price action, tighter range, okay, potentially some consolidations, more of a sideways move. Does some of that sound familiar? It's all stuff that we just talked about. We're already starting to see tighter range. We're already starting to see lower volume. Very typical. Now, we haven't seen price action reverse yet. I think that's coming next week. The odds of this thing moving higher here going into next week, we know that only 13.6% of all occurrences fall outside of this range on the upside. Where do I come up with that number? When we start to see between a 1 and a 2 standard deviation move, like we're seeing now with the yellow pulse bars, we know that only 13.6% of all occurrences fall outside of this range. Odds favor a slowdown or a much needed pullback. Keep in mind, I'm saying pullback here. I'm not saying market crash. I'm not expecting the crash. I'm just expecting a tradable move to the downside here going into next week. That could last a couple of days, might last the whole week. We don't know. What we do know is that every dip continues to be bought. So I don't want to get ultra aggressive on the downside. I'm not just going to say, hey, go jump in with both feet, buy all the puts you can afford. We're not taking that approach. I want to put on some potential neutral to bearish positions with a more conservative outlook. And I'll talk about that more in just a moment. So big picture, markets definitely strong. No doubt about it. Strong uptrend in place, but we're hitting a point now where it really doesn't give you good odds to initiate new long trades here. If you're already bullish and you're already in long trades, that's fine. Don't have a problem continuing to hold those positions. Maybe move some stops up along the way, try to lock in a little bit of profit along the way. But initiating new long trades here, for me, it just doesn't meet my criteria. I would rather wait for a pullback first. And on the downside, if you do want to put on some neutral to bearish positions, the credit spreads, in my opinion, are going to be the better route to go because they're more forgiving trades. And I'll talk about that more in just a moment. Now, expecting this market to potentially slow down or reverse, we actually took action on that yesterday afternoon with our overnight pop trade. And let me go over to the trade page and let's show you the trade that we took. The overnight pop trade, it's a trade that we like to take the afternoon before expiration. Okay, so we know that a lot of the products on our watch list have weekly options. They expire on Friday. Thursday afternoon gives us the opportunity to come in and sell some credit spreads that would benefit from the time decay being extreme, that close to expiration, and to potentially take advantage of some price extremes. And because markets were so overbought, we came in yesterday afternoon and we sold an out of the money call spread on SPY. Specifically, we sold the 409, 411 call spread. You can see it here on my screen. All that means is I'm selling the 409 call. I am buying the 411 call at the same time. We put this trade on initially yesterday afternoon and we collected 54 cents. We sold the spread for $54 per spread. It tied up $146 of our capital per spread to put the trade on. Okay? The whole idea was for SPY to stay below 409. Okay? Markets were overbought. We've been higher for 2 weeks in a row. We talked about the pulse indicator a few moments ago. We were expecting to move lower. We did not get it. Clearly, we can see price is above 409. It's at 409.55 here at the moment. So what we ended up doing this afternoon, I just sent out the closing alert here 30 minutes ago or so. And we ended up closing the spread out. We took a partial loss. Now, let me show you the numbers here because I want to walk you through a couple things. So it's this line here down at the bottom, this last trade that I just put into our performance spreadsheet. You can see the details of the trade. We collected 54 cents, tied up $146 of our capital. Get a dollar sign in there. And that $146, that's the most I can lose on the trade. If I am dead wrong, the most I'm out is $146 per spread. The only way you're going to lose that entire $146 is if you hold all the way to the close this afternoon and price finishes above 409. I wasn't willing to hold. We know the last couple of weeks specifically, Friday afternoons have been extremely strong. We've seen rallies into the close, and with volume light here today, volume's extremely low. I'm not expecting any type of a reversal. If we were going to get a reversal here, we would have seen it already. We would have seen the volume pick up. We're just not getting that. So we ended up closing the trade out this afternoon. Keep in mind, we've been dead wrong on direction. We closed it out for 63 cents. It gave us a $9 loss per spread, $27 loss overall on our position if you are risking $500 per trade, which is what we recommend as a starting point for many of our customers. So it was a 6% loss. So the reason I love this trade, why am I pointing out a loser and saying why I love the trade? Because I was dead wrong. Price action didn't move lower. We've seen very little selling pressure here today, and we only lost $27 on the overall position. Okay, so we're still profitable on the week. We're still profitable for the year. I mean, it's been a very nice stretch for us. The key piece to remember with this overnight pop trade is the odds and the numbers are going to be in our favor long term. It's a very forgiving trade. All we needed was a move below 409. So I've already had a couple of questions come in on this one. If we need a price below 409, we're only sitting at 409.58. I mean, we still have a couple hours to go in the session. All we need is a 58.60 sell-off here to the downside over the next couple of hours. That's still very doable. Why not hold on to the trade and see if that happens? Potentially get into a small profit. I wasn't willing to take that risk. I gave it as much time as I possibly could here today. In most cases, I like to close these trades out in the first hour to 90 minutes of the session. I carried this trade into this afternoon, trying to see if we could finally get a reversal, trying to get any type of selling pressure. It just didn't happen. And when you take a look at the volume being light, every single mini dip that we've had today has been bought up. I just wasn't willing to take the additional risk. I didn't want to let this thing turn from a partial loss to a full loss. We were able to close it out, take a partial loss. No one likes to lose money, but if we can keep that loss small when we're dead wrong, that's the key piece. Long term, that's going to be to our benefit if we follow that approach with these overnight trades. All right. So that trade has been closed out for a losing position. Now, I just mentioned a few moments ago, markets, nothing has changed. The overbought condition that we were looking at yesterday has just gotten even more overbought here today. Could I potentially look for another opportunity going into next week? SPY is one of those unique products that has 3 different expiration cycles each week. We have Monday, Wednesday, and Friday expirations. So I could potentially put a trade on this afternoon with options that expire on Monday. So let's go ahead and take a look here. Let's go ahead and open up the April 12 options. Those are the ones with 3 days left to expiration. Let's go ahead and open those up. And let's go to the out of the money calls. Let's take a look, and let's just go to, we'll start out by taking a look at the 410 calls. I'm going to right click on those 410 calls, go to sell, and go to vertical. It's going to pop up an order down at the bottom where I am buying, I'm selling the 410 call and I am buying the 411 call. I'm going to change that 411 call to 412. What I normally want to do on these trades, I typically want to keep my risk reward. I want to be in that risk 2 or 3 to make 1 range. If I collect 68 cents here, which is the current price of this spread, let's take a look. I'm right around risk 2 to make 1. I'm risking $132 to make 68. That's a pretty decent ratio. If I took this trade as is, I'd be perfectly fine with it. But what else could we do? What could I do to adjust this trade? Could I potentially adjust these strike prices and move them farther out of the money? Ideally, I want my short strike, in this case, the 410. I want that short strike as far away from the current stock price as possible. Let's take a look if we move that out to 411. So I'm moving the short strike to 411 and my long strike to 413. Let's see what that does for us price-wise. It's trading for 46 cents mid-price here at the moment. What I would be interested in on this trade, if we get filled right at 46 cents, we're right around risk 3 to make 1. We're a few pennies worse, actually. I actually like this trade better for a few reasons. Number one, it gives me more wiggle room for price action to continue to move higher here, and I'm still okay. In this case, I need price below 411 on Monday. As long as it stays below 411, we get to make money. So I don't care if the stock moves up, down, or sideways. As long as it stays below 411, we're okay. We make money from the time decay adding up, which it will. Keep in mind, the time decay adds up all weekend as well. Even though the markets aren't open Saturday and Sunday, the time decay is still adding up with these options losing value. So we're able to take advantage of that with the credit spread. And then we also make money if volatility decreases. So we got 5 different routes to follow on this trade. Would I place this trade now as is? No, I would not. Here's why. I would rather wait for this afternoon into the close. I would wait for the last 30 minutes of the session. Markets close at 4 o'clock. Equity markets close at 4. But these index products actually trade until 4:15. You have an additional 15 minutes to put this trade on. I would wait because it allows me to see, do we get any type of movement between now and then? Maybe we get one more push to the upside into the close. If that happens, it would allow me to potentially move these strike prices again. If we get a rally higher, maybe I move those strike prices to 412 and 414. So it allows me to see what happens going into the close. It also allows me to take advantage of the better volume that we're going to get in that last hour of the day. So everything we just walked through to structure this trade is valid. I'm just not going to actually place the trade until this afternoon. And in a perfect scenario, I would actually like to collect closer to 50 cents, or 50 cents or higher would be even better. In order for that to happen, we would need one more push to the upside on SPY. Okay, so this would be a trade that I would ideally like to close out during the first hour of the session on Monday. For that to happen, we would need to see some type of a move lower, either at the open on Monday or right after the open. Very possible, because we already talked about the market being so overbought. Right? So this is a potential trade for us this afternoon for Monday. All right, let's take a look. Pull up my notes here. For those of you that are part of our NASDAQ Options Superstars program, we put a trade on yesterday afternoon on ATVI. This is Activision Blizzard. So we put the position on with a long put. We talk a lot about the credit spreads. We've done so now for months. We continue to use almost exclusively credit spreads in this market. I'm not saying I'm opposed to long calls and long puts. I'm just being very picky. If we get markets to pull back, if we start to see some selling going into next week, I'm absolutely interested in some long puts. But I'm very picky on what is valid for us as far as long puts go. So yesterday afternoon, we were looking at ATVI. It was one of the weak names on the board. You can see it's down another $1 today. So definitely one of the names lagging behind. And we came in and we utilized the May 21st options, and we went out to the 95 puts. These are right here that I just highlighted in blue. We put the position on yesterday for $3.58. We spent $358 to put the trade on. This trade is now pricing right around $4. So we've got a small profit on it so far. Where would I be looking at for a target? Let's go ahead and take a look here. Let me switch the symbol to ATVI. And let me switch this to a 130-minute chart. Let that load up here. So we saw the trend strength histogram go red. We saw it go from blue to red here yesterday, and it finally finished here this morning. And we also saw price action break below the AEMA. Okay, that was the basis for the trade. You can see our pulse indicator was also yellow. This could have been a credit spread opportunity as well. We could have sold the calls for it, and I would have been perfectly fine with that. I wanted to mix it up a little bit. Wanted to get some long put exposure on. Again, I'm very picky on when I take those trades, but with this market so overbought, was trying to look for one of the weaker names here the last couple of days, try to get some long put exposure on that would position us well if we do start to get some follow through to the downside next week. So my initial target on this trade is $7.16. Where did I pull that number from? Whenever I buy an option, doesn't matter if it's a call or a put, doesn't matter if it's a debit spread. Ideally, my initial target is 100% return. I'm looking to double my money. So in this case, I was still at $3.58. Looking to double my money. My initial target is at $7.16. My stop initially is at 50%. So my stop is at $1.79. That's how I'm going to manage the trade. Now, doesn't guarantee we're going to hit a full winner. There are times I will take the trade off with a partial profit. We'll just have to see what happens here going into next week. So that is the trade from yesterday afternoon. Those of you that are part of the NASDAQ service, hopefully you saw that trade come through and got the position on. Rich, Mike, can you mention that ETF trades to close should be made by 4 p.m.? There's a possibility of the ETF to be put to you if it moves higher between 4 and 4:15. Yes, great point, Rich. So a few moments ago, I mentioned that SPY, the index products, will trade till 4:15. You get an additional 15 minutes to trade options on those products. You've got to be cautious with that. You've got to be careful during that last 15 minutes because liquidity is definitely lighter. I mean, you don't have as much volume during that last 15 minutes, and you can definitely see some whippy moves. So there could be cases where, let's just say you're short a spread, okay? Your short option, your short call option, for example, is sitting right on top of the current price. Markets close at 4 o'clock. You're saying, hey, great, I was able to make the money on the trade, book the full profit, only to find in the last 15 minutes, that 4 to 4:15 window, markets continue to move higher. And that trade could go from a nice winner to a loss almost immediately. You can also have assignment risk, as Rich is pointing out. Okay, if that short option goes in the money, it can potentially be assigned. So that's why for those of you that are members of our programs, I get this question a lot. Why do I recommend closing out of trades early before expiration? The overnight pop trades, we're always closing them out for a partial profit. I don't hold into expiration. Why? Because going back a number of years, I got burned on that last 15 to 30 minutes of the session too many times, where I had trades that were profitable all day long. I try to hold into expiration, then you get a late day reversal and you get burned. You go from a profit to a loss. So what I have found is that it's a much better choice to close the trades out before expiration, before the end of expiration day, book your profit, take your partial loss, free up the capital for the next trade, and not have to mess with the stress that can come during the afternoon of expiration. So yeah, it's, Rich, if it's gotten you here lately, trust me, I've been there. I mean, it happened to me so many times. And, years ago, a lot of us would hold the expiration to avoid the commission costs because none of us wanted to pay the commissions to close out of the trade. So just hold the expiration, hopefully book the full profit. Well, now with Tastyworks not charging a closing commission, and if you're using another broker, I mean, commission costs are so cheap now. It's really not to your benefit to keep all of that risk just for the sake of not wanting to pay commissions. So you're definitely going to be better off closing out of the trades well before the end of expiration day. All right, let's take a look at one more potential new trade setting up for us for next week. This is Netflix on a 130-minute chart. Notice on our pulse indicator down at the bottom, for the past, pretty much into the entire week, we've been yellow. So we're at an overbought condition. Prices between a 1 and a 2 standard deviation move has me interested in a potential neutral to bearish position. Because you take a look, I mean, clearly, guys, the trend is higher. Not debating that, right? I mean, it's definitely been a strong move to the upside. But now you've got to ask yourself, okay, if I'm not in a trade already, is now the best time to put on a bullish trade? It's not. The odds don't favor price action going higher. Doesn't mean it can't happen. It just means it's not statistically probable. Do I want to come in and just get ultra bearish? Do I want to come in and buy long puts? I do not. Price action has not confirmed yet. But because we are overbought, because this pulse indicator is yellow, I do know that this will typically lead to either a period of consolidation like we saw back in February, like we saw again in March, or potentially a reversal in the other direction. So this has me interested in a potential neutral to bearish position over the next couple of weeks. Remember, I'm expecting a quick move lower next week. Not saying it's going to be huge, but it doesn't need to be if we use the proper strategy. So let's go ahead and jump over to the trade page. Another reason why I like the credit spreads here, if we take a look at a long call or long put, depending on what expiration cycle you're using, okay, and these are expensive options. You start to take a look at buying a long put on Netflix out in May, the May monthly cycle, you're talking about potentially $3,000 a contract. They're expensive. Now, we do have earnings upcoming. The earnings are out on April 20th. So I personally don't like to hold positions through earnings. Not my style. I don't like the additional risk. I prefer to close the trades out before the earnings are released. You can make money around earnings. You just need a lot to go right in your favor. It's definitely a more aggressive approach. So if I need to be out before expiration, it's really limited in what I can do. I basically have to use the options expiring next week, the April monthlies. So it's an aggressive trade. Let's go ahead and open them up. Open up those options. Let's go to the out of the money calls, and I'm going to go out to the 565 calls. Why am I starting there? Notice my probability out of the money column here. We talked about this earlier in the week. It has a 67% chance of closing out of the money. Ideally, I like to sell the option that has as close to a 65% chance of closing out of the money as possible. Okay, so I'm going to right click on the 565 calls, go to sell, and go to vertical. It is going to pop up an order down at the bottom where it's currently trading for around $1.27. Now, could I take this trade as is? I could, but the premium's a little bit light. If I click on confirm and send, if I were to place this trade as is, I'd be risking $375 to make $125. It's right there. I mean, I like to risk between 2 and 3 to make 1. This is barely meeting that criteria. So could you take it? You could. But let's see what other options we potentially have here on this type of a trade. In order to collect more premium, I'm going to have to move my strikes closer to the current stock price. What if I move the 565 to 560 and move the 570 to 565? What does that do for price? Now it bumps the price up to $1.67. Now it leaves me with a risk 2 to make one scenario. Now I'm risking 333 to make 167. I like this ratio better. Now keep this in mind. In order to collect the additional premium, I had to move my options closer to the current stock price. When you do that, okay, you don't have as much wiggle room to be wrong. In this case, I need price on Netflix to stay below 561 next week. It gives me a $6 cushion. That's not a huge cushion. I'm okay with that as long as I have a pretty strong directional opinion, which I happen to have. I mean, markets are very overbought. We've already talked about that here numerous times today. So I don't mind taking this type of a trade, knowing that if I am dead wrong, if price continues to move higher all week next week for the 3rd week in a row, the most I can lose is $333 per spread. The most I can make is $167, and I make money 5 different ways. I make money if the stock moves up, down, or sideways, as long as it stays below 561.67. That's the break-even point in my order confirmation box. Where is that number coming from? It's taking the 560 strike call that I'm selling, and I'm adding on the $1.67 credit that I could potentially get filled at on this trade. That gives me my break-even at 561.67. So up, down, or sideways does not matter to me as long as price stays below that level. We also make money from time decay adding up and from volatility decreasing. Any of those 5 would work out in our favor and allow us to make some money. We make money the fastest if Netflix moves lower. First thing next week, if we get a move lower, that would help us potentially book the profit faster. Okay, so that is the trade on Netflix. Haven't put this trade on yet. Okay, again, I do not like to open up trades, at least for me personally, until that last 30 to 60 minutes of the session. Wait to see, do we get any type of move going into the close? Also look for the bigger volume coming up at the end of the day. Right? So that is a potential new trade on Netflix. Going into next week, again, guys, just to circle back to the daily chart, potentially looking for a pullback into that 404 level, right around that 8-period EMA. Down below that, if we do break, I know it's a lot, I know it seems like a long shot at this point because this market has been super strong, but the 20-period EMA, as well as the 20-period SMA, down around the 397 to 398 level. Those are the green lines. those could potentially be levels that are hit pretty quickly. If we do get anything going on the downside, those would be levels that would be of interest to me. If we do continue to move higher going into next week, 410.50, 411, 411.50, those are going to be areas, big round numbers and 0.50 levels that could potentially act as resistance going into next week. All right. So if you have any questions here for today, go ahead and get those in now before we wrap it up. So any questions on positions you have on or any charts that you'd like me to take a look at, feel free to type those in. Otherwise, I will be back next week, Wednesday and Friday. Wednesday for our midweek recap, and then Friday for our weekly recap. If you have any questions between now and then, feel free to email me directly, mike@netpicks.com. All right, so enjoy your weekend, everybody. If you're a golf fan like me, it's a Masters weekend, so looking forward to watching some golf here for sure. So enjoy the weekend, guys, and we'll talk to you all next week.